Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in company filings. Their latest report we are diving into is AvePoint's 10K for the year ending the 31st of December 2025. And let me tell you, it's got more twists and turns than a Silicon Valley startup pitch. We are going to break down what all these numbers really mean for AvePoint's future. Before we dive in, if you are all about getting the real story behind these corporate documents, make sure you are subscribed and hit that notification bell. We also have a growing community on Discord all about unlocking these insights, so check the link in the description below. So this is the annual report, the 10K, and it covers the full year up to the 31st of December 2025. Think of it as the company's yearly report card to investors and really to all of us. Let's jump straight into the money. AvePoint brought in $419.5 million in revenue for 2025. That is a solid jump up from $330.5 million in 2024. This is a nearly 27% increase. If you think about it, this means they are selling a lot more of their software and services compared to the previous year. Digging a bit deeper, the big driver here is their SaaS revenue, which shot up 38.4% to $319.2 million. This is huge because SaaS revenue means money coming in steadily month after month or year after year, which is what investors love. It also means that 76% of their total income now comes from these subscription services, up from 70% last year. They are really leaning into this model and it is paying off. Looking at where this money is coming from, North America is their biggest market, bringing in $164.8 million, which is a 21.3% increase. And this is interesting, IMEA, Europe, the Middle East, and Africa is growing the fastest overall, up 35.3% to $134.3 million. And their SaaS revenue in IMEA specifically grew by a massive 43.1%. So Europe is really embracing AvePoint's cloud solutions. Now let's talk about profits. Moving from a GAAP operating income of just $7.2 million in 2024 to finally a healthy $33 million in 2025 shows they are getting much better at turning sales into actual profit. And when we strip away some of those accounting adjustments looking at non-GAAP operating income, things get even better. It jumped from $47.6 million in 2024 to a very impressive $79.2 million in 2025. This means their core business operations are becoming much more profitable with that increase in revenue. From a cash flow perspective, they generated $85.3 million in cash from their operations. This is good. It means they are bringing in more cash than they are spending to run the business. It is a slight dip from 2024's $88.9 million, but still a strong number overall. Now, for some big strategic moves, they weren't just selling software, they were buying companies too. In 2025, they spent $14.9 million on a business acquisition. This is their way of buying growth and new technology. This acquisition was Widentic. Looking at note 3, we see they acquired 80% of Widentic Holding BV for about $20.4 million. This company helps manage multiple cloud services for smaller businesses, which fits right into AvePoint's strategy. They are essentially buying capabilities and customers. And speaking of cash, financing activities were very busy. They saw a massive inflow of $168.2 million from warrants being exercised. This means people who held options to buy AvePoint stock at a certain price decided to do just that, cashing in their options. This is a huge vote of confidence from those warrant holders and an amazing cash injection for the company. Remember that line of credit from November 2023 with HSBC for up to $30 million. You know that one we mentioned before? Well, it's still there, but they haven't touched it. As of the 31st of December 2025, they still had no borrowings outstanding under that agreement. This means they are self-funded and don't need to borrow money to operate, which is a great sign of financial health. Now, AvePoint talks a lot about security and risk. They claim their Chief Risk, Privacy and Information Security Officer leads the charge. They even highlight her being a finalist for Women in It awards and included in the SEER Women in Security Power Forum 100. Look, while having talented leaders is great, the real question is how well are they protecting the company and its customers? The report emphasizes their certifications like SOC 2 Type 2 and ISO 27001. These sound impressive and they show a commitment to security standards, but here is the catch. Even with all these measures, they admit in the risk factors section that cybersecurity threats are constantly evolving and they can't guarantee they haven't been impacted by undetected incidents. This is a key tension in their business. They offer security solutions, but are also a target themselves. One of the biggest risks they highlight is their ability to keep getting new customers and keeping the old ones happy. They say if they can't do this effectively, their future revenue and results will be harmed. This is a pretty standard risk for any growing company, but with their focus on software subscriptions, customer retention is absolutely crucial. Downturns in its spending or increased competition could really hurt them here. And speaking of economic conditions, they are very aware that a shaky global economy could impact how much money businesses are willing to spend on their services. A slowdown in its spending has a direct effect on their bottom line. They are also mindful of international trade policies and tariffs, which could indirectly make their services more expensive or impact their customers' ability to pay. They really stress the importance of their brand. They believe that if they don't keep growing brand awareness, their ability to get new customers will suffer, and that would be bad for their financial health. This means their marketing and sales efforts are super important, not just for selling, but for building that trust. Looking at Ydentic again, this acquisition in January 2025 for about $20.4 million is meant to boost their small to medium business offerings, especially for managed service providers. This shows they are actively looking to fill gaps in their portfolio and reach more clients. Now here is my take. AvePoint is on a strong growth trajectory. Their shift towards SaaS revenue is a smart move, giving them that predictable income stream investors crave. The massive increase in operating income and non-GAAP operating income shows they are becoming more efficient at turning sales into profit. The cash from warrants exercising is a big financial boost, and their lack of debt is a huge strength. They are clearly investing in growth not just through organic development, but through strategic acquisitions too. However, there are always risks. Their reliance on technology partners like Microsoft and Google means they are vulnerable if those partners make changes. And like any tech company, cybersecurity is a constant battle. They are doing a lot to protect themselves and their customers, but the threat landscape is always changing. Their ability to continue acquiring and retaining customers, especially in a competitive and sometimes uncertain economic climate, will be key. Overall, AvePoint looks like a company heading in the right direction with a solid business model and a clear strategy for growth. They are balancing innovation with a strong focus on security, which is essential in today's data-driven world. Alright, that is our deep dive into AvePoint's 2025 filing. What do you think about their growth strategy and their financial performance? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more insights. And hey, don't forget to join our growing community on Discord, linked in the description to keep these conversations going. Thanks for watching, and we'll see you in the next Decode.